Today we're going to look at tax planning for the foreign real estate investor in the United States. And I can tell you it is really turning out to be a kind of a very interesting situation. When we talk about the foreign real estate investor, what we're going to do, we're going to identify the investor. We're going to identify the investor's options. We're going to identify whether the investor is a resident of the United States or a non-resident of the United States. That's going to make a big difference in the taxes. We're focusing on a non-resident individual real estate investor, and we're focusing on foreign corporations. We will see that there's been a tremendous amount of activity from all over the world in the United States, and it's happening in real estate. It's happening in the real estate areas where the Trump tax bill is leading to changes because of expensive housing, expensive city taxes, expensive state taxes, all on top of each other with some limited deductions now. What we're talking about is really the effect of the new Trump tax bill on real estate. And it is a very, very important help to bring money into the United States. It's raising values all over the place, and the United States absolutely invites this kind of investment here. With the new tax bill, the taxes are really in rental income. The taxes can be down to a bare minimum. So what we're going to look at is the foreign individual who comes here to the United States. We're going to identify the people that we call non-resident aliens. We're going to identify them for purposes of whether they pay income taxes here as non-residents or just like citizens. And we're going to identify them to determine whether they pay estate taxes in the United States, like citizens also. We're going to focus strictly in the real estate field. First, we're going to go through the objectives that the foreign investor has in the United States. We'll look at the basics. We'll look at the different ways foreign investors can invest in the United States and multiple of choices for entities and the way they want to hold their property. And then we're going to look at tax planning techniques. And we will be going through several tax planning techniques that will educate the potential real estate investor on the value of doing some tax planning in advance and paying attention to taxes, because they can be very low in real estate for a non-resident alien, and they can be very high. Now, we also, when we talk about the foreign investor, I'm also including in there foreign corporations. I'm not talking about foreign corporations that are established for this purpose or that purpose. I'm talking about the giants of the world, the non-American corporate giants of the world that really might be coming here. And I'm of the belief that we have to start a certain kind of tax planning, and that's tax planning for the immigrant. But I'm talking about the wealthy immigrant and not the poor immigrant. We are being inundated with talent and wealth. The amount of Chinese people who want to come in here, the amount of Russian people who want to come here. We have to deal with the foreign investor and identify them see what their needs are, help them make profits here in the United States, and ultimately pay taxes. But the way things are in real estate today, I truly believe that there's a lot of tax planning that can be done to reduce the taxes in the early years, particularly in the rental real estate business. So we're going to look at the objectives of the non-resident alien. First, they have limited personal and asset liability. They don't want to be exposed for money and have to go through bankruptcy and anything like that. Next, they want a single U.S. tax to pay. Third, they want to avoid double taxation. They don't want to pay a U.S. tax and a tax in their own country. On top of that, they want to pay a tax that covers both countries but does not duplicate. They want confidentiality. That it's very important because foreigners, many of them are from countries where if you have enough money to invest here, your family might be in jeopardy of being kidnapped from wherever you're coming from. And we can meet these objectives. There's a tax planning where we can eliminate a lot of U.S. taxation of real estate here, income and gains. We can eliminate the U.S. estate and gift tax on real estate. We can eliminate the U.S. branch tax on foreign corporations here. We can make sure that there's a single tax only on real estate. We can take advantage of the reduced tax rates that come from the real estate business and depreciation, and some of the tools that can be used in tax planning. And we want to reduce tax rates. Now, the basics are tax rates, what did Trump do with them? And then we're going to look at the different entities quickly that can be used in tax planning, and entities that the foreign investor will typically choose one of these. We're going to describe the advantages of each of them and their disadvantages. Finally, we're going to look at planning techniques, and this is what we're looking at. How to avoid a double tax. Like I said, you don't want to pay a capital gains tax in Turkey and in the United States at the same time. And number two, how to completely eliminate, by a foreigner who's investing here, a non-resident alien, how to eliminate the U.S. estate and gift tax and the branch tax. How to use the foreign trust as a tax planning tool. How to use partnerships and tax bracket advantages for individuals. How to avoid the double tax on income and double tax from countries that people are taxpayers in. The potential for tax-free income from real estate, partially tax-free income, and then the tax planning tool, which is very important, which is a treaty. The United States has over 50 treaties that deal with taxation with numerous countries. These all can be found online, and they are typically very favorable, even more favorable than the statute is, involving foreigners investing in U.S. real estate. What are we after? Limited personal and asset liability. Yes, we're single U.S. tax, avoid double tax, confidentiality, tax planning for a number of different issues, and how are we going to go about it? We're going to just look at some basics first. We're going to look at the different ways in which a non-resident alien individual can invest in the United States here. They can come in as individuals. They can pay tax as individuals here in the United States. If they meet certain standards, they'll pay a tax only on their United States income. Foreigners can invest in limited liability companies. They can invest in partnerships. They can open up U.S. corporations. They can open up foreign corporations that will serve purposes to help them with certain tax issues, and can open up foreign trusts. They can open up United States trusts of every sort and kind, and have a choice of how to fit the glove to the hand here, depending upon the type of investment, the nature of the investor, and how we use all these different entities to plan to help people pay legally the least amount of taxes that they can in a United States tax planning, in a real estate transaction. Let's first define what we're talking about when we talk about foreign investors, non-resident alien individuals, and foreign corporations. Both are considered to be foreign investors. They invest in U.S. real estate and are taxed similar to U.S. individuals and U.S. corporations on their U.S. real estate income. At the same time, they are also taxed slightly differently and do have advantages to some extent over United States taxpayers. The term foreign individual investors here is used for foreign individuals and foreign entities, trusts, partnerships, corporations, any way that people can figure out how to get into the United States and invest. Foreign investors, the similarities. They'll be taxed on their ordinary income, whether it's from operating income as rentals or inventory sales or other income-producing transactions from real estate. They will, like American individuals, be taxed on their capital gains. That's from the sale of their investments that often are at lower tax rates than ordinary income. Foreign corporations are taxed like U.S. corporations. They have the same rate of tax imposed on capital gains and operating income, which under the Trump tax bill is now a 21% tax. There's also not just income tax and capital gains tax that foreign investors have to be concerned about. They need to be concerned about the estate and gift tax. The United States allows its own citizens to leave millions and millions of dollars without paying a tax on the wealth that they are transferring. And the United States does not assert taxes on foreign investors except where there is some relationship with the United States, like real estate, and foreign investors may come to the U.S. and pay tax only on their real estate and not on any of their other income. The problem with foreign investors and the estate and gift tax, which is a death tax, it's a tax on the amount of wealth that is being transferred from parent to child, the amount of gifts that are being made, and it applies to transfers on U.S. real estate assets. So we have to take that into consideration. There are many ways to deal with it, but we have to take it into consideration. There's another unique tax that only foreign corporations have. This is called the branch tax. Now, a foreign corporation that comes here to the United States is really not supposed to build up big cash reserves in the U.S. from earnings and profits. They want foreign corporations the U.S. government. They want the investors to reinvest their cash in U.S. assets or distribute their cash as dividends, all right? But, however, they are foreign investors who are invested in foreign corporations. The foreign corporation can face a tax of 30% on its profits, in addition to its corporate profits, to the extent that there's a failure to distribute cash dividends. And this can be all planned for, and we will discuss this tax, which is very often a tax in name only and somewhat easy to deal with. The foreign investors will also have a lot of tax advantages. Because of the laws that favor foreign investments, certain advantages foreign investors may find under U.S. tax treaties that govern foreign investors, and certain other benefits that we will discuss foreign investors have access to that are not enjoyed by the typical American investor. Now, up until the 1980s, United States real estate by foreign investors was an easy job to make sure nobody paid any taxes. There was inconsistencies in the law. There was treaties that little island nations were able to take advantage of, treaties that we had with gigantic nations that were linked to them. And in the 1980s, the United States put in a whole new code section to govern only United States real estate. It's a unique set of rules, and it tries to make sure that there's only one tax asserted on a foreign investor, the same as may happen to an American investor. In the case of the foreign investor, it's even easier to have certain investment vehicles that will make the foreign investor pay sometimes very close to no income taxes, depending on circumstances. There's several objectives that foreign investors are affected by and they need to be concerned with for U.S. real estate. They want limited personal and asset liability. That means they want their assets that they buy here protected, and they themselves don't want to be exposed to lawsuits and things like that from real estate investments. The first line of defense is insurance. The second line of defense is to decide the proper entity that the investor can invest in and not be exposed to liabilities, and more importantly, not personally liable for damages that may result from real estate investments. Entities can protect people with different forms of personal liability. The foreigners invested tax, this is the tax objectives we're after for the foreigner. They will want an entity that will facilitate the paying of a single tax on profits, a single tax on gain. They want to avoid double taxation, meaning they don't want to pay a tax in the United States and, on top of that, pay taxes to the countries that they live in. So there's an effort to avoid double taxation. There's an investment and tax objectives. Confidentiality. The foreign investor is an investor who has concerns. Kidnapping in their own home country. If you can be kidnapped in Saudi Arabia and be a multi-billion-dollar prince, you can get kidnapped anywhere. So the foreign investor prefers an entity that requires as little disclosure of their personal information on U.S. tax returns and information returns. One of the ways to satisfy this need of the foreign investor is to use the proper entities. The proper entities will take advantage of tax deductions for certain expenses, tax exclusions for certain types of income, the ability to defer the payment of taxes to a later date, and that is provided to foreign investors under the U.S. tax system. The tax planning tools we're going to look at will allow the foreign investor to eliminate the U.S. taxation of real estate income and gains to some extent totally for a deferred period of time, and to other extents partially for not a limited period of time, but partially as a solid deduction that makes sure the investor's not paying more U.S. taxes than they should. The next goal is to eliminate the U.S. estate and gift tax. This is a very onerous tax on large pieces of U.S. real estate. There are ways to eliminate the U.S. estate and gift tax, legal ways that are used all the time in tax planning tools. There's the special tax we talked of, the branch tax of corporations, foreign corporations that are doing business here and don't distribute their money or don't reinvest their money. There are ways for these foreign corporations to not have to worry about that issue. The taxpayers want only a single U.S. tax from their real estate profits. That can be done. There's also the potential to defer U.S. taxes. Real estate profits can be deferred to much later dates and time with proper techniques. It's also possible for non-resident investors with proper planning to ensure that income is reported in the lower tax brackets among different groups of investors. Let's look at each one of these entities that we talked about and what they might be good for. First of all, we're looking at individual taxpayers, U.S. corporations, and foreign corporations, and we're looking at their income from gains and sales. We're then also going to look at the tax planning technique of the trust and several other important techniques to make sure the lowest possible taxes are being paid by foreigners, non-resident aliens, and foreign corporations and U.S. real estate. The tax rates on this income, and it all depends on income tax treaties and the amount of income that's being reported, the exemptions, the exclusions. But the bottom line is that individuals investing in the U.S. can pay a tax rate anywhere from 10% to 37% on investments of significant amounts. There's also a capital gains tax of 10% to 20% for profits from the sales of not just rental income and operating income, but profits from the complete sale of an asset. There's also a very interesting situation here for U.S. and foreign corporations. The operating income and capital gain income on U.S. and foreign corporations is now been reduced to 21%. And with the right structuring and the right tax planning, this can be reduced by multiples in the early years of a real estate investment. Certain things are still the way they used to be. It always was the case that if a foreigner was being paid a interest income by a U.S. taxpayer, the foreigner would have up to a 30% tax rate, and that would be on the gross amount of the interest that was paid. This really, in a lot of places, didn't make sense because many people are lending money and they have a margin of 1%, and to be paying on a gross amount of tax of 10%, that doesn't work. And there's a maximum tax on dividends paid to foreign investors, and some minimum taxes on the same if these are governed by treaties. Now, we're going to quickly run through the different kinds of entities to just see what gives you the most. I'm going to go kind of quickly because there's a lot of repeat here. Personal liability, if you come here as an individual. Yes, you're exposed. Personal disclosure. Yes, you have to file an individual U.S. tax return. Could you be forced to pay an estate tax on the value of your real estate assets here? Yes, very high. Could you have a high U.S. income tax? Yes. Can you plan for these things? Yes. A certain operating income in the U.S. is taxable at only 20%. However, typically, interest and dividends paid to foreign investors will have a tax rate of 30% on the gross amount of payments. And if you come here as an individual, you won't have to pay the branch tax. That applies only to foreign corporations. Your tax planning techniques are poor to moderate. You don't want personal liability. There's several things I listed that you don't want. The next entity choice, if you come here with limited liability company. Now, the limited liability company prevents you from having liability beyond the scope of the assets that are in that limited liability company. So that's a benefit that the coming here personally won't give you. So that's a positive. Everything else is the same, though. The tax returns are personal tax returns. You're subject to an estate tax and gift tax at times. However, you will have a reduced tax on the operating income that is being earned, the ordinary income that's being earned as rental income, as there will be only a 20% tax rate with benefits that actually can reduce that down to below 3 to 4%. There's no branch tax on a limited liability company. Now, a U.S. corporation is another entity where a foreigner can go ahead and open a corporation in any state in the United States. There's some formalities with identification and what have you. The U.S. corporation is a little better than the individual investment type because there's no personal liability. There's no disclosure. You don't file tax returns. The corporation files tax returns. You still are subject to an estate tax if you die owning shares in a U.S. company that owns real estate, or any U.S. company. There is also a U.S. income tax along the lines we discussed. If you're a corporation, it's a 21% tax. There's still the passive income that's paid to foreign investors have the tax rates without a treaty, 30% withholding rates. And the tax planning techniques of a U.S. corporation are better, as one can see, because there is no gift tax on the transfer of shares, no branch tax, 21% tax on capital gains and operating income under the new Trump tax bill. The next entity is a foreign corporation, which is exactly the same as investing in a United States corporation, with one big difference. And the big difference is that there will be no U.S. estate tax if a foreign investor only owns shares in a foreign corporation and the foreign corporation owns U.S. real estate. They're a foreigner living in a foreign country owning shares in a foreign corporation. It does not leave the United States with any jurisdiction to subject them to certain taxes. The maximum way of tax planning is the tiered entity. When we talk about the tiered entity, we're talking about a chart that looks like page 28. A non-resident investor will form a foreign corporation, typically in a jurisdiction that has very little taxes. The foreign corporation will then organize a United States corporation and own 100% of the shares of the U.S. corporation. And the U.S. corporation will own 100% of the U.S. real estate asset. Now, what is this doing for us? With this tiered corporation, the foreign investor is only buying shares in a foreign corporation, so there cannot be any estate tax. The foreign corporation is buying shares in the U.S. corporation, and the foreign corporation, when it sells its shares in the U.S. corporation or liquidates the U.S. corporation, will pay only a single tax in repatriating all of the gain from sale of U.S. real estate. This serves many, many masters. No estate tax, no individual corporate taxes, either foreign or United States, shares to transfer, limited liability. And that's why this is the best of all worlds with variations on it. When you do have a tiered entity, meaning a foreign corporation owning a U.S. corporation, owning the real estate, you do have limited personal liability on several limits, limited personal disclosure, that's seven junctures, no U.S. estate and gift tax because there's no transfer of anything related to the United States, a 21% operating income, which, as I mentioned, is about increases the profitability of those people who have assets in the United States, real estate that they've held for years. The tax reduction means that they've had a 50 to 60% increase in their cash flow on these assets. So the tiered entity is a very, very good tax planning technique. Now we're going to go into some of the tax planning techniques that are used to ensure that the non-resident alien taxpayer and foreign corporations have the same advantages that the United States companies have. So the first tax planning tool is a situation where a foreign corporation will open a U.S. corporation and own 100% shares of that U.S. corporation. That U.S. corporation can pay a single corporate tax on its rental real estate income and gain from the sale of the real estate. And that single corporate tax will be at a tax of 21%, and treated properly, the funds can be repatriated back to the foreign investor without a second tax. Just care needs to be taken, attention to detail. What we're looking at here is a chart showing a complete liquidation of a foreign investment by a foreign investor that owns a corporation. And we're showing on the right-hand side a situation where the foreign investor does not make distributions of their profits by liquidating and distributing profits, but makes distributions that could be construed as dividends and may incur a second tax. There are ways to deal with this matter also, which will be discussed. So that's the first tax planning tool, the ability for a corporation to liquidate, pay only one single tax, and not have the foreign shareholder pay any additional taxes. Now, what I've shown you in the next few slides is how we do certain tax planning for different situations. We have on page 33, we show a non-resident alien investor owns a foreign corporation, opens a U.S. corporation, but here that investor opened a U.S. corporation, and that U.S. corporation actually opened two other U.S. corporations. Now, what did that do? Well, the foreign investor wound up losing money in one of the U.S. corporations and gaining the same $200,000 in the other U.S. corporation. Well, because of this structure of one U.S. master corporation owning two U.S. subsidiary corporations, the master corporation can consolidate all of these corporate attributes and take advantage of losses against gains. There is a myriad of combinations for the non-resident investor to explore when it comes to tax planning. There are different tax plans for raw land. There's different tax plans for rental income. There's different tax plans for condominium sales. Every one of these is unique. There's different tax structures to ensure that all of the losses that may be incurred in the United States can be used to offset gain. And we're just going to leave it at that the tools are there. And now I want to go through a few of these tools. Tax planning number one. This is where if the non-resident alien does not want to invest personally, then that non-resident alien and any other people can invest through different entities that will become investors in what's called a limited liability company or a partnership. What happens here is if we have a partnership, each one of the partners in the partnership have only the taxable income attributed to them. And when they earn that taxable income, they may want to deal with it in many different ways. And the limited liability company, which is a partnership, which the entity does not pay a tax. All of the partners in the entity pay a tax. And the non-resident alien individuals can come in many fashions and share interests in partnerships that invest in real estate and enjoy low tax brackets because they will have all of their income be accumulated by a single tax entity, but each one of them will separately report their income, and many of them will be in lower tax brackets with their separate reporting and enjoy the benefits of lower tax brackets. The next tax planning technique that I want to discuss is the way to avoid a certain trap that occurs with United States assets owned by foreign investors. When a foreign investor opens a U.S. corporation, for example, and says everything is payable towards capital, there's no debt by the foreign investor to their corporation. The trap that leads to is the U.S. corporation can make profits, and it wants to distribute those profits, but if it distributes those profits, it may have a dividend tax. Well, the solution there is that when a corporation is capitalized, half of the capital is considered to be an interest in the shares, and the other half of the capital is a loan to the foreign corporation. Now, that loan can bear a small amount of interest these days. Interest is going to be going up, but it's still a small amount of interest. And by doing that, when cash is accumulating in an entity, an investment entity, it can be distributed in payment of any shareholder loans, and that's not a dividend, and that will not lead to a double taxation. So we need to keep our eye on how we use interest-bearing obligations to help reduce taxes on U.S. real estate profits. The next entity we're going to look at is called a non-grantor trust. And now, this entity has its own purpose. This will be with a foreign investor who is getting up in age and has plans to leave some of the assets to their children in the future, including their real estate investments. Here, what happens typically is the foreign investor, called the foreign grantor, may make a transfer into a trust, and that trust can have independent foreign trustees. The trust is payable to foreign beneficiaries or even payable to U.S. beneficiaries, because there's not going to be a tax on this trust. And the foreign trust may have several investments, so it may have a U.S. limited liability company that owns one piece of U.S. real estate. It may have another limited liability company that owns another piece of U.S. real estate. But essentially what you have is a trust with independent trustees, with beneficiaries who will not pay any tax on the fact that U.S. real estate is being transferred to them. and that real estate was put into these foreign trusts, or this foreign trust, in order to ensure that there would be avoidance of U.S. estate taxes as best as possible on their U.S. real estate assets. The next planning tax technique, and this only is available pertaining to real estate assets for both the American taxpayer and the foreign investor, is what we call a like-kind exchange, or a technique that allows a taxpayer to pay taxes on gains far into the future, so long as the taxpayer continues to invest in real estate. So what we have is the ability to continue to have real estate that grows in value, and each time that it grows in value, it may be transferred for real estate at its increased value and not be paying tax until the point in time when the real estate is turned into essentially cash or other forms of consideration. And this can go on and on. I've also included here a lot of the issues of technicalities, because in order to ensure that there is no tax on real estate with gains that a taxpayer is now transferring in exchange for another piece of real estate, in order to ensure there is no taxation, there's several details that need to be paid attention to, and there is a way to have independent parties help structure transactions where taxes can continue to be deferred on ever-growing gains in real estate. We're now going to discuss two last issues. The final tax planning tool, which to me is the Rolls-Royce of techniques, is going to be discussed. And then I'm going to switch gears, because we've been talking about income taxes. I've also mentioned how there could be problems with estate taxes, where people die leaving very valuable pieces of real estate, and real estate is subject to a significant estate tax in the United States if an individual foreign investor dies holding that real estate. So we will quickly go through that one at the end, but for right now I want to deal with what I call the Rolls-Royce again of techniques for tax-free income tax planning. And what that is something called the portfolio interest note and the portfolio interest exclusion. What that is a certain kind of note that can be owned. Only a small piece of it, of a promissory note, can be owned by a foreign investor. And so long as that investor holds a note from a U.S. taxpayer and it's real estate involved, the foreign taxpayer, as long as that foreign taxpayer has less than a 10% interest in the real estate investment, if that's the case, less than a 10% interest in the real estate investment, and there can't be sisters and daughters and mothers and fathers all owning 10%, it's a real 10%. There's a particular loan for people who own 10% of a real estate business deal, who can pay themselves interest income that will not be taxable to them when received. This is interest income from rental properties in the United States. They will not have to pay the tax on that interest income. And the companies or entities that they own that are producing this real estate income is able to claim a deduction for interest paid on notes to less than 10% shareholders. And what this does, it is a tax-free deduction. An example can be a $10 in rent, $3 in interest income to a less than 10% shareholder, and $2 in depreciation. Before you know it, with those three investments, the deduction of the interest, the depreciation, and the cost of operating, the actual taxable income can be reduced significantly, especially in early years when several tax deductions on real estate and personal property have been accelerated, so that there is a way to issue a foreign investor shares in an income-producing real estate company and a personal note for a loan by the foreign investor at 9.9%, and the interest paid on that note, which will reduce any U.S. taxes on its real estate rental income, will be paid tax-free. And in addition, there will be no exposure to the U.S. estate tax, as that will be tax-free also. There are several restrictions and approaches to complying with everything necessary to take advantage of the portfolio interest exemption. Now, I'm going to switch from talking about income taxes and capital gains taxes and depreciation and interest and how to make sure that the 20 and 21% tax rates that are in the Trump tax bills are reduced even more because of tax planning techniques. We're going to switch to the issue of United States estate and gift taxes. Now, when it comes to estate and gift taxes, the typical American now can give tax-free $11 million to anybody they wish to, and there will not be any tax on that. At the same time, non-resident aliens who do not do tax planning for United States real estate can either make a direct gift of United States real estate and be taxed on that gift at high tax rates, or may pass away owning the real estate individually, and in addition cause the inclusion of major assets in their U.S. taxable estates. Real estate is one of the prime assets that are not taken care of, that can cause, both from direct gifts and resulting from death, that can cause significant what we call transfer taxes, not income taxes, but taxes on the right to transfer assets to people. And that needs some special attention. Let me provide everybody with a summary. This is what we did. I like to quote Shakespeare. You tell him what you're going to tell him, you tell him, and then you tell him what you told him. And what we did was this. We looked at all of the tax and non-tax objectives of the non-resident alien. Limited personal liability. Limited liability for the assets they buy over here. Limited calls from the United States saying we have a problem. Payment of only a single U.S. tax. How to avoid double taxes between the non-resident aliens country and the U.S. The all-important issue of confidentiality, so people are not afraid for their lives. We looked at tax planning techniques, how to eliminate the U.S. taxation of real estate income and gains by liquidating corporations. Once a single corporate tax has been paid, there is no tax on a distribution to foreign owners of those companies if it's done right. We can eliminate the U.S. estate and gift tax, which could be frightfully expensive since there is only a very small exclusion for real estate left in individuals' names who may pass away, or gifts that may lead to taxation. We've talked about eliminating the U.S. branch tax, which is a tax on corporations, several ways to deal with it. We've talked about how to make sure in tax planning there was only a single tax. We talked about how taxes could be deferred on and on ad infinitum before the payment of taxes. And we talked about how to take advantage of all the deductions at reduced tax rates. That's the tax planning. The entities, we talked about the entities that we chose to lead to an investment entity that fits the investor. The foreign individual investor, which again I say I don't recommend it at all. There's too much liability in every fiber of that. Limited liability companies or partnerships. This is a step in the right direction, where at least there's limited liability only to the assets that are being owned. We talked about the U.S. corporation, which is a further step removed, provides an exit that ensures only a single tax, and provides, I think, with a very low tax rate now, coupled with depreciation accelerated on certain assets, and the potential of a portfolio loan, which will reduce profits on real estate rental property even more, with a loan to shareholders that's deductible for business purposes and not taxable to the creditor. All of these techniques that we will be able to employ, depending upon the size of the investment, the country that the taxpayer is coming from, the treaties that may be involved, the type of property that's being bought, and another myriad of potential ups and downs that I believe we've covered as best we could.